I have Harry Dent with us today. He's the well-known author, but author of the recent book, The Demographic Cliff, and editor of the free newsletter, Economy and Markets. Welcome, Harry.
Nice to be here, Gordon.
Pleasure to have you. I've enjoyed your books. I enjoy your predictions, and I have to tell you, back in the early 90s, you were, I think, the only person calling the boom that we had into the late 1990s and early 2000. I say that because, being a product of the 70s with stagflation, I never saw that happening, and we did. But now your outlook's here on what I'll call the Great Depression. I think some of the people are starting to believe that's coming, but your stand on dollar and gold, I think, and others are very much different. So we'll get into that. But Harry, I wonder if you could describe to our listeners what the terminology financial repression means to you. What does it represent? Because I think it leads into our discussion here today.
I kind of call it, Gordon, hijacking the free markets, and that's what central banks have done. And I'll show a little later, what caused the great boom, because you have to understand what caused the great boom to understand why a great bust. And I also predicted the fall of Japan, which has been dramatic ever since the early 90s, when everybody thought they were going to take over the world. So boom and bust is what we look at. But what's different this time, and really has never happened outside of the emergency of World War II, governments around the world have decided to just print money to offset the downturn. We've had baby boomer spending decline, excessive debt loads, and horrible geopolitical cycles since 2008 especially. And governments have said, well, we're going back to Keynes, but we're going to do it on steroids. We're just going to print trillions and trillions and trillions of dollars to offset the downturn. And what most important in this first slide is critical to understand. They don't just set short-term rates. They've always done that. In the Great Depression, every downturn in history, they'll push short-term rates down to encourage more borrowing to help offset. This time, they said, no, we're going to do more than that. We're going to print money and buy our own bonds, our own treasury bonds and mortgage-backed bonds with this money to push long-term rates down to zero. That is the big kicker. Short-term rates are not that big a deal. It encourages speculation more than borrowing in a bad economy. Long-term rates push down bond rates so low that it pushes everybody to go into stocks and other financial assets, and it allows firms on Wall Street to very cheaply leverage up 20 to 30 to 1 and even buy safer assets like bonds and make high returns because the government's giving them money for free. So when this happens, and there's no question about this, and we've already seen it, you get massive misallocation of investments. Companies are borrowing money mostly to buy back their own stocks and engineer mergers that wouldn't be possible without such rates. The whole fracking industry could not have happened without such low long-term rates on high-risk drilling. And now they'll never be able to do this again with lower oil and when rates eventually come back up. So misallocation, most importantly on Wall Street, banks and financial institutions, everybody's in the speculation game, betting on a market that always rises, fed by money coming in by these institutions. There's always the bid, always somebody investing. Everybody buys on dips. Well, this bubble, which is even greater than the one we had before, is about to burst. And when it bursts, it's going to wipe out all this excess gains, and all this financial repression will have just caused a bubble that's going to destroy wealth even faster than it built up artificially. So it's bad policy. It's saying we don't believe in the markets anymore. We don't believe in the markets to readjust and to, force different investments or cutbacks and things like that. We're just going to keep trying to keep the bubble going forever with zero interest rates, and that's extremely dangerous. When money is free, it will be abused, and most of all, as anybody knows, and this is the most obvious part, if you're a baby boomer aging, trying to save for retirement, well, guess what? You get zero adjusted for inflation, short-term, long-term. You can't make money, and then you're forced to go into the stock market and higher yield bonds, which means you're going to get crucified again, just like you did in 2008. So this whole thing is actually, it is sinister. It comes down to, governments and especially central banks saying, hey, we know we created a bubble. It got out of hand. We know that when bubbles burst, you get depressions and deflation, which are devastating, and nobody wants that music to stop while they're in office, so they just keep the bubble going. And I tell you, I wouldn't want to be I wouldn't want to win the election in 2016. The next president is going to get the bulk of it, and the next Federal Reserve chairman, whoever that is going to get the worst, because you can't keep a bubble going forever. It's that simple. You can't. And this is really, really stretched now.
Yeah, it's amazing that it's went this far, but the amount of malinvestment we have, mispricing of risk, the lack of pricing power that's going on, or price discovery, I should say, and now it's oversupply, lack of pricing power. It's got to come to an end, but never underestimate central bankers' ability and governments to keep kicking the can. But something's going to happen here.
Yeah, and and I have underestimated that, like most people. I would have never thought. It's more like $12 trillion now it's been printed. And that's not counting China's massive overexpansion through just unbelievable government-backed lending. So you can't underestimate them, but again, you can only take it so far, and I think we've done that, because what people don't understand, people say, well, why, with all this money being put in the banking system with quantitative easing, why aren't banks lending more? They're not lending because businesses already overexpanded in the boom from low interest rates and stimulus, and consumers also overexpanded and overbought housing and overinvested in stocks and everything. We overdid everything. Now we have slowing demand against that excess valuations, excess capacity in industry, so nobody needs to borrow. No, consumers can't afford to buy a bigger house. They already bought a bigger house than they can afford. Businesses don't need to expand. They already overexpand in the boom. So when the supply siders come out, who I normally favor in normal times, and say, well, if we just lower taxes and do this and lower interest rates, we'll grow. No, we're not going to grow. All this money's going into speculation. Nothing is worse than creating a bubble that's going to burst, because bubbles destroy wealth at the speed of light. And they suck in everyday people, which is the worst part. It'd be one thing if it was just Wall Street. I don't mind seeing them go down. But the everyday person has basically been forced to invest in real estate and stocks when they shouldn't.
Well, that's the thing that troubles us most at the Financial Repression Authority. Pensioners, people who have saved, who are now are in serious problems, and it's getting worse at a significant rate. And I think we're starting to see that in the U.S. primaries right now, with both parties, various groups. May not be able to describe the problem, but they're frustrated, and they know something isn't working for them. Something's wrong, and they don't, and whatever they call it, the establishment, but somebody isn't doing their fiduciary responsibility somewhere, if I can be as simplistic here. But they're facing, the governments and central banks are facing incredible headwinds, deflationary headwinds associated with demographics and what you refer to as the spending cycle. And some of this is very logical, but on a day-to-day, we tend to forget it, and has profound impact. You have some great slides. Could you take us through those, Harry, just to help our listeners who aren't familiar with some of your core thinking this way?
Yeah, and I tell you, economists have no clue on this. It's surprising. This is the simplest thing. Any everyday household can understand this, because we're describing what people like you do as you age and enter the workforce and earn money and raise your families. And the first slide is just the consumer spending cycle by age over the life cycle. And it's very simple. Most people don't enter the workforce till age 20. Then they go up a steep spending cycle. And we get this from 10 years of consumer statistics taken by the government every year. This is very accurate data. It goes up with the home buying and cycle, and it starts to slow down at 39, because people buy their largest home well before they peak in spending, because it's when your kids turn into nasty teenagers and everybody needs more space. That's when people buy their McMansion. That's age 39. So we start to grow slower. We peak at age 46, which we hit back in 2007 for the largest numbers of baby boomers. But then we still keep going with auto buying, and especially with quantitative easing. The affluent people go to school longer, and then their kids go to school longer in their cycle. So their whole peak spending is about 6 years later, and it's only been magnified by quantitative easing, because it pushes up financial assets like stocks and real estate. And these top 10, 20% own almost all the financial assets outside of people's own home. So this shows that the correlation with the spending cycle with the baby boomer rising, and it's a massive generation, which I'll show next, that we had our first peak in 2000 when things slowed down and we had the tech wreck. And then the real peak was in 2007, which I predicted 20 years ago, Gordon. I mean, back when I developed this indicator. And then now we're at the final peak where the fluent people, who may just be 20%, but they are 50% of income and spending. So they're the other half of the economy, and they've been going like gangbusters until recently, when you see luxury good stocks going down, which we've been predicting. So we're going to see the biggest, what I call demographic cliff, as there's no longer these affluent people to offset the declines of Homer Simpson. And now how is the government going to stimulate spending with all this, phony stuff and financial assets? So that's number one. The second graph is what I'm most famous for, which I came up with this in 1988. I just take the birth index, which I adjust for immigration, and projected forward 46 years for the peak in spending of the average person. Man, how simple can you get than that? A new generation moving increasing numbers in their peak spending. And after that, that's where you get your headwinds. And this is why since 2008, when this peaked in 2007, governments have been doing endless quantitative easing and stimulus just to keep the bubble going enough so at least the affluent people will keep spending, even though Homer Simpson's not. And this is why, again, Sanders and Trump on both sides, it's the everyday person that's seen their real wages go down since 2000, while affluent people have gone up and up and up, and they're not sharing in the wealth in this great financial asset bubble because they don't have anything other than their home and a little bit of stocks. And so they're losing, and they do see something is wrong. And then, the Bernie Sanders side blames Wall Street and big government, and Trump blames, bad decisions and trade agreements with the government killing jobs and immigration. And all of these things are happening. So, but the point is, this demographic trend keeps pointing down until 2020 to 22, until the next slightly smaller generation comes along. Now, number one, long term, we will never see a boom in the United States like 1983 to 2007, because this generation was so much larger and so boosted on top of that by immigration. But it will be that long, and the demographic trends get much worse between 2016 in 2020. So this great crash, I think, is finally going to happen because, governments have been able to stave it off as long as this wealthy 50% of GDP are still spending, but they're not anymore.
Yeah, exactly. And we've got it the middle class, as you're well aware, and we have a 70% consumption economy, and it's the middle class that spend and buy items. The top 5% are buying financial assets, not goods that produce goods.
And yachts and crazy stuff.
And you're killing jobs.
Yeah, killing jobs. Now, I just give you an example. The middle class was about 60% in its heyday in the late 60s and early 70s before innovation and globalization started to work against it so strongly. It's down to 36% now, and they only control 19.6% of the wealth, the lowest percentage of any developed country in the world. Switzerland's the only one close to us, and Sweden. Other countries still have the middle class controlling a minimum of 40% and some as high as 60% in Australia. So this is why our middle class, this financial repression and quantitative easing has worked, and the extreme inequality in income, which is far greater here than Europe and most other countries, has really worked against the average person. Now, one more chart, though, to really bring home. In the last several years, I've had to bring in other cycles because this demographics is the most fundamental. But after 2002 crash, I thought, my gosh, we're going to have another bubble, just like we did in the Roaring '20s in the tech cycle and all this stuff in the demographic cycle. It wasn't as bubbly. And I had to realize, boy, what changed the geopolitical cycle since 9/11? So I came up with a 35-year geopolitical cycle that's positive for 17 to 18 years, like 83 to 2000, and then negative from like 2001 to 2019. We're obviously in a bad geopolitical cycle, and it's obviously getting worse, and it doesn't bottom until 2020. Innovation, internet, just like automobiles and stuff and electricity in the early 1990s, massive increases in productivity. Well, that's fading because that cycle's fading. Now the internet's all about Facebook and people having fun and watching dancing dogs and stuff, I mean, that's fine. It's good. Facebook will do well, but it does not create the productivity that email and Google and stuff. Email and Google alone tripled my productivity in economic research. I have a third the research staff I used to do, and we do twice as much research.
I just interviewed Martin Armstrong. I don't know if you know him, and he has something called his economic confidence model, and he studied cycles going back 200 years. And I got to tell you, it mirrors exactly what you're saying here on your red with the 35-year geopolitical cycle specifically, and that's what his focus on. And he's got the same conclusion you've got between now and 2020. Him, in his case.
And then there's one more cycle. We have about 10-year approximate boom-bust cycles, but I kind of got a secret way of measuring this. It's actually 8 to 13. And this one's an off cycle. This cycle points down from mid 2014 also into early 2020. It's something scientists can project. So that is the final thing, because I found that 88% of the downturns come in this cycle. Any major financial crashes or recessions come in this cycle. And I think this is going to be the hardest thing for central banks to fight. So here's the point, Gordon. These four cycles, and I go back to the 1800s. I'm just showing since 1900 here. These four cycles only turned down twice in the last century before this. And that was in the early 1930s, the Great Depression, the worst stock crash in U.S. history. And in the early to mid 70s, the next greatest stock crash in recessions and downturns in U.S. history. So between now and 2020, just like Armstrong said, I mean, this is when we're going to have a great reset and crash. And again, governments are fighting it tooth and nail, and now it's negative interest or zero interest rates weren't enough, as we showed in the very first graph, and zero long-term. I mean, the Treasury's at 1.7 adjusted for inflation, which has been average 2%. Those are negative. Negative interest rates, I mean, zero aren't enough, so they go negative. But you have to notice, Japan, when they finally went negative recently, their stock market's been down since. There's a point where this crazy stuff just doesn't work anymore. And I think that's the breaking point when governments have to admit, oh, we have to go negative now. So this is very ominous. I've got another two graphs that are important. One is that we show that we've had three bubbles in stocks since 1994, the tech bubble. First peaked in 2000, we had a crash. Okay, well then we had a second one with the baby boom rising into their peak, and the continued strong technology cycle, which is another cycle I have, by the way. And then a bigger crash. Well, now we've got a bigger bubble from artificial, and it's built on nothing, which is worse. And this chart says a megaphone pattern, higher highs, lower lows, the next low, and that's not going to be the bottom because we won't hit that till 2022. But by around late 2017, by my best estimate, we're going to see a Dow of 5,500 to 6,000, and nobody sees that coming. Economists are saying, yeah, we're overvalued. We might get a 10, 20% correction in a healthy bull market. I'm saying no. This is going to be the final bubble, and this is going to be the 74, 75 crash or the 30 to 32 crash equivalent. You're going to see the worst crash, I think, in stocks and in most other assets in your lifetime, probably in the next year and a half. So I'm telling people, if you want to sit in the market and say, well, I might make another 5 or 10%, first of all, the next chart shows we've gone nowhere since November 2014, a year and a half. I see it in a rounded top, and we're right at the edge of that. If we can't break substantially higher in the next few weeks, I think we're headed down, and then this thing's just going to build on itself. And I can tell you, Europe is going to be in deep trouble. Greece is in trouble against Cyprus. Italy is in. I've got charts, banks failing in Italy, like unbelievable. There's no way you can bail out that country. I'm predicting by the end of this year, Italy's going to be the next Greece, and that is it for the Eurozone. They already got immigration problems, debt problems, slowing growth despite endless stimulus. China's got the biggest bubble in the world. Its stock market cracked 45% in 2.5 months, not too long ago, and it's going to crack again this year. By the end of this year, China's market's going to be down that much again. And so what can the Fed and central banks in Europe do about that? That's going to send a shock wave in spending and in further in commodities and especially in real estate, because it's the Chinese buying all the leading edge cities, New York, London, Vancouver, Toronto, San Francisco, LA, Sydney, Melbourne, Singapore. This is Chinese buying these things and bidding up the high end, and that's already cracking. So I think we got a big bubble getting ready to burst. Governments have gone out of their way to keep it from happening, but it's going to happen between 2016 and 17, continue for several years on and off. And again, I would not want to be the next president. And if I were, I'd want to walk into it from day one saying, this is a bubble. I did not create this problem, and I'm going to help turn it around. But I would not be going in like a lot of the candidates saying, I'm going to create jobs, I'm going to do this, I'm going to turn around our economy. They don't have a chance. I'm telling you, no chance of turning around this economy in the next 4 years. So you better say, I'm going to bring this back in balance and restore the middle class, and not say I'm going to create 3 million jobs.
Harry, we fully agree with you, the Financial Repression Authority. We are concerned, and why this could be so dramatic and so quickly. The amount of debt we have and the leveraging we have and the amount of collateral that's through things like rehypothecation, that when something starts to crack and the collateral goes, the whole system. It just will implode. And when we had the 2007, 2008, we were blessed in some ways that it was U.S. centric, and so the Federal Reserve could step in with 11 different facilities. This will be global, in a fragile and complex, and I don't think anybody's got the abilities to figure it out in any kind of real time of how to fix it or get agreements. And so it could be that dramatic and that quick. Don't want to preach doom and gloom here, but certainly there's major concerns as you're articulating. What do investors do about it? What do you see kind of the major themes to how they can protect themselves right now?
Well, I hate to say, this is one time you just cannot listen to your stockbroker. You just can't. They say asset allocation, we got you diversified, and stocks always go higher. No, they don't. After 1929 peak, stocks didn't get back to there until 1953, 24 years later. Same after the 1968 peak in stocks adjusted for inflation. Didn't get back there until 1993, 25 years later. So you're going to be dead by the time stocks come back if you buy them now. This thing is simply to realize this is a once-in-a-lifetime reset. It happened in the 30s. It happened in the 30s and 40s and stuff. It happened once in a lifetime, and you have to simply get out of the way. We've had bubbles and everything. Everything's bubbled. Commodities have already collapsed, and gold is halfway there. But real estate's bubbling again, and even more so around the world. Stocks are bubbling everywhere. Get out of risk assets as much as you can. Maybe keep your home if you're going to stay in it. And if you want to downsize, do it now. But minimize your risk and exposure and get in safe stuff. Cash and cash flow is king in a downturn. That's what Joseph Kennedy did. Joseph Kennedy got out of the top in 1929 and bought stuff at 10, 20 cents on the dollar. You could have bought anything in 1932. You could have bought earthworms. You could have bought real estate in any sector, any stock that survived, any commodity, and made money for decades because of a reset that happens once in a lifetime. So you have to get out of the way, and you have to say, look, okay, yeah, Harry and people like you guys have been warning. But what if this goes on another year? Okay, it goes on another year. You might make 5 or 10% if you're lucky in stock. If we're right, you're going to lose 60 to 70% by the end of 2017. You want to play those odds. Those are very bad odds. It's best to be safe, get in cash, and then there's going to be a series of bubbles that are going to burst, just like they've been bursting. Commodities have already largely burst. And you're going to be able to buy different countries, different stocks, different bonds, different commodities at different times, and then invest long-term again. But you can't do it now. Get out. Do not listen to your stockbroker. This is the one time they don't know what they're talking about.
This chart you have up with the 3 peaks, this is a classic megaphone. I've never seen a megaphone this long in duration. And as a technician, there's only one way this megaphone ends. I mean, it's just a classic.
Gordon, it is a classic pattern. And I see people on the financial media talking about chart patterns. This is the one they don't talk about because they don't want to see it. We're in denial. Bubbles build on denial because everybody benefits. Even the average person has got a lower mortgage and car payment because of this bubble and zero interest rate, but particularly the affluent and investors. And governments benefit. Everybody benefits, so everybody goes in denial. I get people looking at me like I'm like Satan coming from hell or something. And I'm like, look, I'm not a bearish guy. I'm the guy that predicted the great boom, But great booms end up in great bust. And if you can find a great boom that didn't end up in a great bust, I'd love to hear it. If you can find a debt bubble that didn't end up in deflation, if you can find financial asset bubbles like the 20s or this that didn't burst, they don't correct, then show me. You will not be able to find it because I'm like Martin Armstrong. I've studied every cycle known to man. I've studied back billions a year in climate and stuff.
For our new listeners that may not be familiar with yourself and think you're being negative here, I've got to tell you that during the 90s, even I wondered about your optimism.
Oh, yeah.
And we thought you might have been just a little crazy positively, as somebody would accuse you of being negative right now. But you've been right. And the data would suggest something is coming. All we're going to talk about is the degree of how bad it could be. But the point is, you need some insurance right now. This is not the time to be taking risks. This is the time to be prudent. Comments on what you see happening in terms of gold. We have a lot of gold followers here on our site, precious metals, hard assets specifically, and the U.S. dollar.
Well, gold was a bubble too. I mean, I debate Peter Schiff and a lot of people, and they say, oh, bubble, 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 bubble. I said, well, what about gold? They say, oh, gold's not a bubble. Gold went up 8 times between 2001 and 2011 in 10 years. Stock bubbles usually last 5 to 6 years, and they go up 2, 3, 4 times. 8 times. There aren't many bubbles bigger than the gold bubble. And now it's bursting. And it's bursting because a lot of the gold bubble happened after 2008, where gold went down in the last crisis. Everybody thought gold was going to save you. No, gold went down 33%. Gold went up the most when they saw all this money printing and said, oh my God, this has got to lead to inflation. Well, it didn't, because deflation is the trend. When debt bubbles deleverage, money that was created out of thin air disappears. When financial bubbles burst, markets go down 70, 80, 90% and don't come back for decades. It disappears. When money disappears, that's deflation. Less money chasing the same good. It doesn't matter. The government would have to print $100 trillion the next time around to fend off what I see is the financial asset bubble bursting globally, which is going to destroy at least 100 trillion assets. You can't print that much money. They might print 20. They're not going to print 100. So deflation is the trend. Gold is an inflation hedge. People say it's a crisis hedge, but 9 out of 10 of our crises in the last century or two have been inflation crises. Like the 70s or OPEC embargoes. Wars are always inflationary. This is a deflationary crisis. And this is the one time gold will not do well. Gold correlates hundreds of years back, adjusted for inflation. It goes nowhere, but inflation is no better hedge. And now gold, we should have charts that show gold totally correlates with inflation. No other factor. It also correlates with the commodity cycle. And guess what commodities are doing around the world? And we're the only people that forecast this just about years ago. I have to argue against Jim Rogers that, the growing middle class and emerging world can drive commodities up, 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 up. I'm like, Jim, I got a 30-year commodity cycle that says down, down, down. And we've overreduced, and China has led this by overbuilding everything and manufacturing stuff they can't sustain. China has caused this bubble burst largely, and it's bursting. I think gold's going to be at 700-ish sometime in 2017, bounce and ultimately settle closer to $400, maybe a little lower in this longer term cycle. And then when gold bugs say gold could go to 3,000 to 5,000, I say, yeah, in the next commodity cycle that peaks in 2038, 2040. The problem is you and I will be dead by then. So gold is not the place for now. I hate to say that. Might have a little bit. I'd rather have silver coins that I can trade and barter with. What's the Krugerrand going to buy you in a convenience store? Sort of thing. But this is the one time in the cycle. Most of the time in the cycle, we either have moderate or extreme inflation, like in the 70s. This is the one time where we have deflation. So I don't want to be in commodities or gold and silver. The U.S. dollar has been the best hedge. It goes up versus other currencies, as it did in 2008 when we have a crisis, because we're still the best house in a bad neighborhood. And we're going to have a terrible time, but Europe's going to be worse. And I don't even want to talk about China. China is going to be the biggest urban disaster in modern history because they've overbuilt and stranded 250 million people that aren't even registered citizens with low-paying jobs, building stuff, all types of stuff, condos, malls, roads, everything for nobody. And when this stops, those people are dead, and they can't even probably go back to their rural homes because they've been paved over with empty condos. So China is so bad I can't even talk about it. And economists worship China. That's how clueless most economists are. They're just trend followers.
And they got some major flaws here. In terms of gold, if you're right at $400 or anywhere in that area, I might argue, Harry, that it would say, yeah, but that could be absolutely right, but it'll say, what will that $400 buy you? Because gold has a store of value. And in a Great Depression, you may be better off at $400 in real purchasing value of that gold, because it'll be the same.
The difference is if you're holding $1, it won't go down in value. You're right. The gold may go down in value, but it will buy more versus that value because there will be deflation. But that dollar will not go down. In fact, it'll go up if you buy it versus other currencies, and it will buy more compared to deflation. So I still like I'd rather be in UUP, the dollar index ETF, than in a gold ETF, GLD. That's all I'm saying.
Now we're the same. We're of the same school too. With the dollar, we believe will be the last to fail.
Last to fail. Again, I'm not bullish on the dollar forever.
Flight to safety, the perceived safety, and if everything's kind of sinking, it's still the one that's floating a little bit better. So, but that's just the road to failure of a fiat. It's about a fiat currency failure. That's we see as a central issue. What about, in kind of wrapping here, what about other investment areas? You know, with this spending cycle, doesn't it suggest things like big pharma, retirement areas, medicine, healthcare are going to be investment areas?
Yeah, yeah. In the demographic clip, I've got like the 10 best demographic sectors, and a lot of it's around health and wellness and things like that. And even cruise ships do great. I mean, people, the older people get, the more they say travel's too hard. Just put me on a cruise ship and stuff me with booze and food, and I'm happy, you know, and no changing hotel rooms and customs and stuff. So there's a lot of areas, but here's the problem with that. When stocks crash, like in the 70s or in the 30s, when you get a major long-term crash, price earnings ratios collapse. The risk premium goes way up on everything. And I went back in the 30s and said, you know, what about booze or gambling or movies or toilet paper or everyday consumer goods, you know, utilities, phones, things that people wouldn't cut back or might even spend more on. They all went down, just not as much. So if I'm going to be in stocks, yes, I'd rather be in pharmaceuticals or vitamin companies or something like that. Or gosh, nursing homes. They will never build enough nursing homes for baby boomers. Never, ever, ever. If you're in that sector, you're going to boom, you know, longer than I will live. So, but those stocks will still go down. Those are the stocks I want to buy when we see the Dow go down to 5,500 or later. And in countries like India that have, and in emerging countries that have incredible demographics, they're going to crash too. They're already crashing. I want to buy them. And even the U.S., we got to have a much better future. Europe will never be the same. Japan has never been the same now for 25 years, and it only gets worse. They have no echo boom to create a next boom in a lot of the developed world. At least we have a sizable one. It's not bigger than the baby boom for the first time in history, but it's sizable. Australia has a giant echo baby boom because of their immigration, and the Chinese are falling all over them trying to get out of their country. So there are places we want to buy, but I don't want to be in anything right now unless I'm in some sort of inverse fund or that UUP that bets on the U.S. dollar going up. And that same thing, if the dollar index, which is at 94 right now, is in a trading range, I think it's going to go up to 120 or so. Once it gets there, I am neutral on the dollar. The dollar's caught up with the rest of the currencies, been the best house in a bad neighborhood. After that, I'm neutral, and I'm not going to be necessarily recommending the U.S. dollar, but I think it's the best hedge for the next crisis outside of just cash. But the difference is the U.S. dollar index versus our 6 major currency partners will go up in value while your dollar will just hold itself.
You made a very good point that the time to buy will be after we've had the fall, if you can protect your wealth, because the free cash flowing kinds of opportunities at lower price points are going to be phenomenal investments.
Phenomenal. This once in a lifetime, I call it the sale of a lifetime.
It's in a lifetime drop, but the buying opportunity, there's going to be fortunes that are made. How do you get from here to there? Where do you hold your assets during this impending problem?
Well, first of all, have a minimum assets in your normal checking or savings account with your bank. You put your money, when you sell these assets, you put them in a brokerage account in your name at a brokerage firm or at your bank, but it's not in a checking account because banks can lend money against bubbled up real estate against your checking account 10 to 1, and they do. And so that's how you get a bank run when all of a sudden real estate goes down and they say you got this much money, but they say, well, we don't actually have the cash because we just lost it all on bad loans in real estate. So you want to, and in that fund, you can be in a money market or in cash or in UUP, and it's under your name. And if a financial firm really gets in trouble, that's why you want to pick a good one, then there might be some stall, but that's your money. It's not like they're going to say, oh, actually, we lent this out, so we don't have it. It's your money. And you can control it, and you'd be safe. And then when these things happen, 2 years from now, you start buying India, and then 4 years from now, you start buying gold, and 5 years from now, you start buying U.S. stocks, and there's this progression, but you do it all in your account. Don't have money, don't have a bunch of cash sitting in a savings account at a bank or a checking account. It has to be a broker.
Well, I'd caution our listeners too that understand the new bail-in laws that are coming, that are now in place for financial crisis, and whether they'll seize your assets under the bailouts or bail-ins.
Bail-ins, and that's what they did in Cyprus, and they're going to have to do this in Italy, and they could do it here, and it's going to affect wealthy people.
If it's as serious as you're suggesting, and we're on your side on this one, These are the kinds of reality you're going to see within the banking system. We happen to believe quite strongly you need to be considering being outside the banking system, outside the financial, if nothing else, because it's nothing more than an electronic representation of credit or an IOU or an asset as opposed to a real asset.
There's one other thing I bring up that I've got my money in a brokerage account with a firm that is just a trading firm. They don't lend money. Even some major online trading firms make real estate loans and stuff. So I want a firm that does not have exposure to all this leverage, credit default swaps, which are now $550 trillion, by the way. Talk about leverage in the system that can break down in real estate loans and all this sort of stuff. They're just simply a transaction firm. All they do is buy and sell stocks and ETFs and things for you. That's who I want to be in. I don't want, because that's what's going to happen with regulation of the banking system again. Banks and financial institutions have gotten all in each other's businesses, and now they got cross exposure to each other. So that's what happened to AIG. One little sector of their firm melted down and killed their whole insurance firm, which was still solid. They had one speculative division that was basically investing 20, 30, 40 times leverage in credit default swaps where you get killed. So you want to be, if you are in a firm, whatever firm you're in, U.S. or international, or make sure they don't have exposure in loans and investments. They're just simply investing for you. That's it.
When you consider there's thereabouts a $600 trillion unregulated over-the-counter swaps marketplace out there, and the U.S. economy itself is $25 trillion, you've got to ask yourself a lot of questions. How could this be? And is the real system solvent?
Well, you know how that came up? They created all these mortgage-backed securities and all these bad investments and stuff, and Paxton said, well, hey, they may smell kind of bad, but they're diversified, number one. And number two, they're insured. They're insured by speculators with no collateral. That's what credit default swaps are. Somebody takes a bet on high leverage and says, if this bond goes bad, I will make good on it. Well, what happens if that speculator loses money because they're investing in leverage stuff, and then they say, okay, make good on my bond. Oops, I'm bankrupt. So people say, and the financial institutions say, oh, 600 trillion, it's no big deal because it's longs and shorts. They mostly offset each other. The guys who are long aren't going to be there when you need them to pay off your bond. So it's BS insurance.
All the crises are often centered around something called counterparty risk. And that's when you learn about people who can't make payments on commitments that they've met. Harry, we have to wrap here. We're getting up against our hard line. So much more to talk about. Any key messages you'd like to leave with our listeners here in wrapping?
Well, it's the same in business. Hunker down. I don't care how bad the economy gets. Somebody's going to survive in the business you're in. If you're the one to hunker down first, if you sell off assets you don't need, if you do everything to create a treasure chest of cash and cash flow, you're going to survive, and your competitor's going to fall, and you're going to come out of this stronger than ever, 5 times stronger. So it's the same extreme wealth opportunity in business as it is in investment, and we know only a small percentage of people will see this. Everybody else goes with the denial, listens to the experts. Warren Buffett, of all people, says everything's okay. He's doing a great disservice to the American public because he's trusted, by the way. So you just have to say, look, we've had a great bubble. We've had all these gains. Let's cash in. Let's be safe for at least a year or two and see if people like us are right. And if we're right, man, you are going to be so happy. And you just have to have the guts to do it and not listen to your neighbors and listen to your stockbroker and all these. Everybody's going to tell you, don't do this. Looks like you would have missed this much gains. Well, again, last year and a half, no gains in the market. If you'd have been in the typical stock or small cap stocks, you'd be down 15%. If you're in biotech, the hottest sector, you're down 40%. If you're in China, you're down 40 to 50%. So there's already been losses. And if you're in commodities, you've been demolished. So, take this seriously. I'm not asking you to stay out forever. I'm just saying this is the time to be safe. And I can't tell you when that final grain of sand will cause that avalanche in the mound of sand, but it will happen, and it will happen quickly. And bubbles burst twice as fast as they build. The 1929 bubble went down 89%, but it saw half of that. 45% of that fall came in the first 2.5 months, and that's what just happened to China last year. So you think, oh, I'll wait till there's proof. No, you don't wait on bubbles. And who's the guy, Baron Rothschild, Somebody asked, "What's the secret to your wealth?" And he said, "I always sold a little early."
It's always true. Very good one. Comment. Harry, how can our listeners find out more about your writings and your research, your outstanding research? And I understand you also have a special on your book, too.
Yeah, you go to harrydent.com. We're giving away our updated version of the demographic cliff for free. All you have to pay is $4.95 shipping, and that's our hard cost, believe me. And we're also there. We've got a place where we have the Economy and Markets, our free newsletter. All you do is put in your email and you're on. It's a daily newsletter, 6 days